And so I just click that side button.
That's recording now.
That's recording. And you haven't plugged it in yet though?
No, it's plugged in.
It is? So we're on, we're live. Even live on the thing. Okay. Get everyone seated. Let's go. Huh? All right, everybody. Let's grab your drinks, get a seat. I promise there will be no magic tricks, so you can sit at the front. Huh? Yeah, don't worry. I can pronunciate. Hello. Hey. Right, come on everyone, grab a seat. Good. Where do I cut off the... Yeah. Come on everybody. Navi, grab your customers. So one of my team, there's just the music playing. Can you just get the staff to come turn it off? Somewhere behind there. I'm just going to go, I reckon. Cool? All right, hello everybody. Thank you very much for coming. To the back, can you hear me? Do I sound good? Nice acoustics? Cool, fantastic. Welcome to our Williams Corporation Funds seminar. Purpose of today's seminar is... Right, that's great. Yeah, but we're not clicking. Purpose of today's seminar is to tell you who we are, what we do, what options we have available. Now, the focus of today's seminar is on our funds, our financial instruments, but as you know, we can't discuss our funds in isolation. So we need to be talking about Williams Corporation, we need to be talking about the property market, we need to be talking about our subsidiaries to give you a really good, deep idea of the wider business. I'm just going to keep going.
Go for it.
So, starting with me, now I believe to get a really good quality presentation, you need to validate your source of information. So what I want to do is I want to present to you my CV in 30 seconds. So my name is Matthew Horncastle. I'm going to be your speaker tonight. Now I come from a family where everyone is in construction. Mother, father, auntie, uncles, granddads, cousins. It runs very, very deep. It makes for very awkward Christmases. I am a qualified builder, so I've served my time in this industry from the ground up. I'm a business thought leader in New Zealand, so you'll quite often see me on TV or hear me on the radio or see me in the newspaper, and sometimes the articles are even positive. I live in and I invest in Williams Corporation property, so I'm not a charlatan. Everything we're going to be discussing tonight, the funds have my money in it. The properties, I live in a Williams Corporation home, and my investments are Williams Corporation investments. So everything you're going to see tonight, I am one of the larger investors of all of it. But my largest claim to fame is I am the co-founder of Williams Corporation. And Williams Corporation is one of the largest privately owned builders in New Zealand. Cool. Questions. Questions will be done at the end. If you have something and you need to get it out, we've got a small group, so I'm happy to do individual questions. But if you can hold it in, I'd love to do questions at the end, and we'll spend a bit of time and we'll go through everything. You can ask everything. This presentation is for you, and we're going to go through and make sure you're comfortable and make sure you know everything you need to know. Now, every great presentation needs to have a legal disclaimer. So, legal disclaimer for today's presentation is myself and my team, we're not financial advisors. What we're giving to you does not constitute individualized financial advice. We do everything we can to make sure our claims and make sure what we show you is factual, but make sure you do your own research and seek your own advice before making an investment decision. Now, starting with Williams Corporation. Who is Williams Corporation? What do we do? Now, Williams Corporation is a residential property developer. We build homes that are affordable to buy, affordable to live in, affordable to maintain, where you can live, work and play. The way to visualize our brand, we're an upper mid-tier property company, okay? We're not the cheapest, we're not the most expensive. If you were to compare us to a car brand, we're a Tesla, we're a Hilux, okay? We're something that's done well by professionals. We are people that focus on the first home buyer, the investor, the downsizer. We focus on creating a product that most people in New Zealand can afford, a product that's built really well, and a product that you're proud of, and a product that we can drive past and 30 years from now, knock on the door and the owner would shake your hand and make you a coffee. So that's really our values. That's what we want to be doing. Now, a little bit of our track record. Last year, we delivered 209 houses to our customers, valued at $120 million. And in our career, we've delivered over 2,000 properties. I think it's actually 2,300 now, at 1.3 billion. So we're not a little company anymore. I used to love doing these seminars where we were the young guys trying to take on the world, but we're now a proven part of the New Zealand property market. We've been through it, we've got the scars, we've got the bruises, and we sit here in the property market as a known player. Pretty much everywhere we go. The delay in the clicks a little bit disconcerting, isn't it? Cool. So, because this is a fun seminar, we're going to show you data that we don't normally show. And this is for you if you're looking to deploy capital, you've got millions of dollars burning a hole in your pocket. We want to show you that we're the real deal. So what you're looking at on the screen is on the left-hand side is our left-hand side is deliveries, right-hand side is sales. So let's start with sales because this is an amazing story. So in FY17, we sold 3 houses valued at $1 million. Now, 4 years later, we sold 631 houses valued at $350 million. We were an incredibly fast-growing company. Yes, we had a tailwind of a fantastic property market behind us, but we had this amazing ride where we put the right product in the right time, to the right way, to the right people, and we had so many people that wanted to do business with us. And I can see a few faces that have been here at the early seminar, and I want to know I appreciate it. I want you to know that I appreciate it. And so we went on this wild ride from $1 million in sales. Now, one other disclaimer, this is just our property development company. We do have other interests, but they're less consequential compared to these numbers. So for the purpose of today's presentation, we'll just do the property numbers. But we've been in business since 2014 with 2011 with other things. We then hit the peak of the market, and our sales go from 600 down to last financial year, we sold 200. Last financial year we sold 260, and we bottomed out at the bottom of the market at 180. Now the deliveries are slightly more stable because there's a lag, and it sort of seems to iron out. So the sales are a lot more up and down, but the deliveries are a lot more steady and smooth. So you can see our first real year as a property developer, we delivered 52 houses. At the peak of the market, we delivered 519. Last year, we delivered 209. So you can start to see that number. And if you were to say, what is Williams Corporation today? Williams Corporation's an infill residential property developer that sells about 20 houses a month, okay? At the peak of the market, we sold 100, right? 100 houses. It was absurd. And obviously, those times don't last forever. And so when people say, well, how's the market? Are you not doing well? Well, compared to our best ever month, we're down a lot. But we're a respectable business that sells and builds a lot of houses. We've adjusted our overhead and our cost structure to fit perfectly, if not a tiny bit mean, for a business that builds 200 to 250 houses a year. So, summary. What is the summary of Williams Corporation? We're good people. We're a local Christchurch company. We're good at what we do. We're very boots on the ground. You'll see our sites around the place. You'll see our people coming and going with high visors and white utes. And we're a company that's very, very in love with construction. We're in love with what we do. We really care about it. It really matters to us. And we're also very, very honest. There's something about the construction industry. Most people just feel the need to constantly lie. You'll hear builders, pretty much every builder that tells you how many houses he builds, you can divide that by a multiplier because the truth's normally far lower. Now, with Williams Corporation, because of our fund and because of our public scrutiny, everything we tell you is the truth. The numbers behind us are our actual numbers, maxes our tax returns. That is exactly what we do. And we've had the FMA come through and have a look at our funds, and that's something that we're very proud of, our honesty and our integrity. Cool. So why are our homes so popular? Why has a relatively new business come into a relatively competitive market and outcompeted some pretty serious competition? We have some builders in the market with big balance sheets. There's some publicly listed housing companies there. We've got some builders that have been here for a long time. We've got franchises made up of lots of different owners. How did a wee Christchurch firm come and compete? And it's hard to put everything we've done in the last 14 years to a slide because it's so much deeper than a slide. But we build a home that's built really well. We care. Every detail is gone through where, what paint do we use and why? What insulation do we use and why? What structure do we use and why? Every detail has been thought out and argued with, and thought out and argued with, and gone over and over and over and over again until we perfected our craft. We call it the piñata test, which is you need to be able to put an idea on the table and be comfortable with everyone beating it up, and only if your idea can survive does it make it in Williams Corporation. And so our homes are well built, they're in great locations, they've got great finishes. We do all the extra little things that the owner doesn't know when they're buying off the plan, but they do know the first week that they move into their home, that those little things were done for them with care and with passion to make sure they're happy. That lag, right? Cool. So one thing we have done, when Williams Corp started, our original hypothesis was we wanted to take a home that was slightly smaller than the traditional home in a far better location than houses were being built. If you take your mind back to after the earthquake and you look at that environment, pretty much all of the housing supply were bigger townhouses in the fringe, or it was out in the suburbs. And Williams Corporation was like, we're going to take a better quality than the market's used to. We're going to take a smaller footprint than the market's used to. We're going to take out the car park. We're going to hit a price point that no one's hit before. And we're going to let anyone participate in property. And one of the great measures that we had was, could someone on minimum wage that's been fiscally responsible for a year or two walk in and buy a house? And that was always the benchmark that we tried to hit. Now, coincidentally, from that benchmark, if you hit that home that first home buyer could participate in, you made a home that was very attractive to an investor. So not only did we create a market where people could participate, we made a product that was very investor friendly. And we got a large amount of business. Now, from that, we've developed that vision, and we're now doing bigger complexes where we can get really good land and even better cost per lot, so we can hit even more competitive price points. And then we can give really great quality amenity. So projects at the moment, we're now putting health clubs in them. So majority of the new projects we're releasing, they have saunas, they have spas, they have outdoor courtyards, they have cold plunges. They have an environment where someone that's on $27 an hour can buy their first home in the city and live like a millionaire would. And that's something we're really proud of, and that's something the market's responded really well to. So this is one of our projects now that's available, 20 Wilma. You'll notice the size, there's 50 units in this complex, mixture of 1-bedroom townhouses, 1-bedroom apartments, and 2-bedroom apartments. You see the health club, which looks really cool. You notice the price point, which is very, very sharp for a city development. And we also developed the site next door to this development and the site next door to that. So it really shows the depth of what we're doing within the city. Now, the work we've been doing in New Brighton is something I'm very proud of. I've got to stop saying really proud of, I need some different describing words. No one had a really good crack at New Brighton, and we saw it, and we saw that beautiful beach, and we knew that we could do more as a city in Brighton. We've now built over 100 houses in New Brighton in 2022, which was a very, very difficult property market. We were selling these as quickly as we could build them. And we found we could build a 2-bedroom townhouse overlooking the ocean for $650,000, master suite overlooking the ocean, and it was something that people wanted to purchase, and it was something that allowed us to do volume in a very difficult property market. But it also gentrified an area and started to make this area beautiful that as contemporaries, we all want our beachside towns to be lovely and developed and have cool infrastructure. So this is our most recent development in New Brighton, 87 Marine Parade. Again, there's 50 units in this complex. Again, you've got this cool health club. So you've got your sauna, your spa, your cold plunge, your outdoor area. And we have a new 60 square metre, 1-bedroom apartment overlooking the ocean with these beautiful ocean views with a car park for $548,000. So fantastic, fantastic project. And also this project caught the eye of one of the biggest institutions in New Zealand, and we actually did a collaboration deal with a large company called Centuria, and they underwrote this development with us. So now we have a partner that's got $20 billion of assets under management, a balance sheet exceeding $1.5 billion, a company that's publicly listed that wants to do projects with us. So it just unlocks this whole new layer of capital, of wealth, of people, of opportunities, of contacts we didn't have that allows us to really sink our teeth into new things. So really love this project. And then we have our flagship. I was here today showing a friend of mine, Manchester Square. So Manchester Square was actually a collaboration essentially with the government. So as you know, the east frame, which is the residential strip of land, was divested by the government to have a residential strip around our new city centre. One of the partners wasn't building at the rate, so they divested new blocks, and we got one of those blocks, and we're actually working on 2 more now. And so Manchester Square is 111 units. It's a mixture of commercial along the Manchester Square face. We have apartments, and then we have a belt of townhouses around the side. And this is our first 6-storey building. So until then, we had only ever built to 3 stories. So this was really us showing that we can participate with the commercial builders We're not just a wee building company that does stick frame construction. We're not just someone that can build townhouses. We're someone that can do these big projects with the big companies and participate. And this project's majority sold. We're going to be delivering it sort of October, November. Great price point, blue chip location. Very, very, very cool. Before I jump into the other services, I just want to spend a bit more time on our townhouses and our construction. We have development offices in Christchurch, Wellington, Auckland. We've also built houses in Tauranga. In our history, we did open up in Australia back when I was slightly more bullish. But as the market got a bit weaker, we wanted to sell everything we had in Australia, and we wanted to bring that cash home, and we wanted to make sure us here at home were strong, we were well capitalised, and we were focused. And it's something that I'm very proud, those decisions we made. At the time, it was a real 50-50 decision. We could have left that capital there. Financially, probably be a little bit richer, but we made sure home was safe. We made sure we did the right thing by our funders, we did the right thing by our investors, we did the right thing by our customers. We were well capitalised, and we built out our book. So, what are the other services we provide? One of the things we noticed as Williams Corporation in the most recent market cycle was that property development itself isn't the full answer. And the problem with property development is you're dealing with a large chunk of money, with a long time to build, with lots of nuances and complexities and things that can happen. And yes, you can keep your eye on it. Yes, you can focus. Yes, you can nail it. And that's what we do every day. But there's a greater property market that we can capture and service for two reasons. One, financially, we make money, right? But two, we can make sure we do it right by our customers. And we noticed with these service businesses, lots of them we handed off to other parties, and we didn't get the outcome we wanted for our customers. And we knew if we were there with our people micromanaging it, we could get those outcomes and make sure our customers were happy and make sure they got the return that they wanted and the return that they needed for trusting us with their property. So, what are those services? Right, starting with property management. 7 months ago, we launched Managed by Williams. So Managed by Williams is our property management company. We do short-term accommodation, long-term accommodation, and commercial property management. And it's about making sure if a customer buys a house, we get them the return they want. And it's been incredibly well received by the market. Since we started this company, we've onboarded 2 clients every single day. So we've had our fair share of chaos because it's a difficult feat to do. But it shows how many people trust us, how many people want us looking after their greatest assets, their property portfolio. And what we can do is we can run this in a manner that's far less commercial than a property manager. So we shamelessly disclose to you, we look at this like a lead generation source, okay? We want you to buy a property, make as much money as possible, and buy another property from us. So we can do things that an other property management company wouldn't do. We can spend money on advertising that would equal a whole year's worth of fees, and that wouldn't make sense to a straight property manager. We can have people and staff and infrastructure employed that wouldn't be commercial to a standard property management company. So we stand here and we say, we run Managed by Williams. We have equity to our key managers in our cities. Ben runs it here in Christchurch. And so we have our trusted people that have been around for a long time, who you all know, who are there in each city looking after you. And then we have Williams Corporation behind saying, we want you to make money from your property, so you buy another property from us. We then have Williams Corporation Real Estate, Williams Real Estate, which is with Carl, one of our finest. And essentially the purpose of Williams Real Estate is we want to solve 2 key things. There are people who own older property that want to repurpose that capital into new property, and we want to be there to assist you to do a professional sale of that asset, get you the right price, and help you transfer that to New Williams Corporation homes. Or if you'd bought homes from us and you're at the end of that journey and you want to sell them, you want to spend it, you want to have your European summer, we're there to help you sell it, make sure you get the right money, and make sure the completion of that investment works for you, the customer. Quite ominous, this click part, isn't it? Now, one of the other things that we're very, very passionate about is making sure New Zealand remains a country of homeowners, okay? If you go back 30 years ago, 85% of Kiwis own their own home. Today, that's 65. And as a country, that gets really scary when that drops below 50%, because now the voter base isn't incentivised to maintain property rights. They're not incentivised to follow the values that built the Western world. And what is the biggest thing stopping people from purchasing property? That is capital. So Own with Williams is a company we're very proud of, and it's a company that is there to help that person that's just started in the workforce get onto the property ladder, that's had a divorce and had their capital stripped from them, get back into property. The person that's come from a different country, that's immigrated here, and as they left their country, they converted their money and never got what they should have, gets them participating in property. So this is something really special to us and something that really matters, making sure we have the people that live in this country, own the property they live in, then they care. They care about the schools, they care about the government, they care about the streets, they care about the parks in a manner that you don't have when you don't have ownership. So this is here to take someone that couldn't otherwise financially participate in property and get them onto the property ladder. So what does that look like in a cycle? We can build a fantastic house, as you know. We can manage it for you professionally. We can maintain it, we can sell it. And so we're not here to build a house, take the money, and end the transaction. We want to be with you for the entire journey. We want to be with you every step of the way to make sure we're doing what's right by you. So now, let's talk about the wider property market. I'm going to present to you briefly what I believe to be the fundamentals of the New Zealand property market, because the biggest percentage of our book is still residential property, and there is a macroeconomics component. And when I look at the macroeconomics ahead of us, I'm confident that the residential property will remain strong, and we're just going to go over a few key reasons why. But before I do a few key reasons, I want to know what you think. I want to know where your gut is and how you feel. So what we have behind me is called the property clock. There are no wrong answers. The whole purpose of this is to see how you, the audience, feel, okay? Now the way it works, top 12 o'clock, that's the peak of the market, okay? Bottom, 6 o'clock, that's the bottom of the market. So from 12 till 6, we're in a deteriorating market. And from 6 to 12, we're in a rising market. Make sense? Right, I want someone to yell a number, or multiple people. Where do we feel it is? No wrong answers. 7? Cool. Anyone else? 8? Let's play a game. Does anyone think we're before 6? 1? Cool. Where would you say, sir? Probably like 5. 5? Okay, a little bit more pain to come. Let's do a show of hands. Who thinks we're after 6? And before 6? Round 6? Okay, cool, good. There are also markets within markets. So pretty much everyone in Christchurch, as a rough rule of thumb, will say 6 or after, right? So we get somewhere from 6 till 7. Wellington, they're still pretty upset. They're still floating around sort of a 430. And Auckland has just hit 6 now. They're like, right, we're back on, let's rock and roll. A lot of property is about sentiment, okay? Because I can go over, and I can't actually remember what slides I have about economics, but I can drill over supply and demand imbalance, cost of rebuild, housing deficit, people per dwelling. I can do all of that, but really the mood of the nation conquers most economics, how you feel. And I've been doing this property clock now for 9 years in presentations, and I've ridden this right through the cycle, and people's sentiment in rooms like this is almost more powerful than the macroeconomics. But let's just do a little bit of macroeconomics. First thing, the main thing for property is a growing population, and New Zealand is a fantastic country to live in, and we do have a growing population. Now we have periods where it grows slowly, like during COVID. We have periods where it grows slowly, like this year. But last year we were growing at 3%. So the main thing with our population is New Zealand's population appears to grow anywhere from 1 to 3% on average every year, and it's a rate faster than our housing supply. So I don't like that slide. I'm going to read this slide anyway, but essentially this was the stats from last year. This is true. So last year, the New Zealand immigration was 140,000 people through immigration. Our natural births over deaths is around 20,000 people, right? So we have this huge population growth, but the key thing that grows our population isn't our births over deaths, it's our immigration. Now this year, that number's only about 40,000, which to me makes no sense why you would let 140,000 people in one year, then 40,000 the next year. You'd think they would pick a number and do it stably. But it is a little bit jerky. But the main thing is there's a deficit when you look at a 10-year period or a 5-year period. We have a population growing faster than our supply of housing. And one of the key things to look at is this number here. Now, this is people per dwelling. Now, at the moment, there's 2.6 people per dwelling. And what appears to happen is the wealthier a country is, the more this number goes down. So the single person wants to live by themselves in an apartment, the couple only wants to live together, the person with 3 people in a flat doesn't want the third one there, the parents with the adult kid want the adult kid to leave. So we always want this number to be pushing down. But what happens is when we have fiscal issues, when we have events that make us poorer, like high interest rates, we suck it up and this number goes back up a little bit. So the parent's house takes back the adult kid. The flat gets the extra flatmate. The person with 2 houses sells one and only has one, right? This number goes back up. And that's what's been happening. That's what's been happening through this most recent period. And that's why instead of on the news every single day, like we've seen for the past 10 years going, housing shortage, housing shortage, housing shortage, it magically vanishes. And it's not because the economics changed of how many houses we're building and how many people there are. It's because people per house changed, right? Because we got a little bit poorer. One of the key things that puts a lot of pressure on housing is the replacement cost of homes. Now, for you, the consumer, you deal with consumer inflation, and your consumer inflation sits at 2.6%. So every year, your money's decreasing in value by 2.6%, or the goods and services you're purchasing are increasing in value by 2.6%. For us builders, we deal with construction inflation that's 2 to 3 times consumer inflation. So every year we build a house, it's 6% or 9% more expensive than it was the year before. And what happens is because the replacement cost of homes is perpetually increasing, that drives up the price of the existing housing market because that house is 6% more expensive every year to rebuild. Now, one of the main places we see this, and we see the data before we see it in house prices, is in rents. So essentially the 10-year average for rents is increasing at 5.6% a year. So rents are always increasing. When you look at this graph, it's pretty aggressive. For those in the room that rent, you'll already know this, but rent's pretty much just head in one way. And then the main thing that makes us feel richer, the main thing that makes us want to deploy capital into property is interest rates. So what you're looking at here is the official cash rate. And essentially, sorry, there's some errors in these numbers. Oh no, that's right, sorry, that's bang on. At the moment, you can borrow money at about 4.8%, and that's the average buyer. As you'll know from those that have bought property recently, you normally get a cashback as well. So it's quite often for us to see 4.8% and a 0.4% cashback or something equivalent to that to the buyer. So this is decreasing. One thing I do want to address is the Reserve Bank appears to act a little bit like a drunk driver. And for those that know me, I'm a little bit critical of government, right? But we head into the global financial crisis, right? And we're dealing with inflation. And so they're lifting these numbers, lifting these numbers, realise the economy can't sustain it, realise we've got this huge economic shudder, and they do this huge drop to reinvigorate the economy. And that is why the GFC was only 1.5 years, right? Because the Reserve Bank did this really big drop. Now, they lifted it too high in the beginning and dropped it too low, which we'll deal with shortly. And then we come into COVID and we have a similar incidence. We have money being dropped too cheap. We have inflation, obviously. Then we have this huge lift. Then they shutter the economy and we have all sorts of turmoil and crashing asset prices. And then this big drop. Now, my personal belief, they still actually haven't dropped it enough to restart the economy. And we're going to see sort of another 75 basis points. We can see here this number at about 2.5%. That reinvigorated the economy out the back of the global financial crisis. And I think we're going to need to come back to the same number to get that same stimulation. So for me, I think we're going to see another 75 basis points, 0.75% come off, maybe even a bit more because they've left it so long. They have to give it a bit of a kickstart. Now, what does that translate to? This is the most important graph, okay? What you are looking at is the New Zealand median house price in 32 years, my life, coincidentally. And there is a boom and bust nature of property, okay? This is real. But there's also a perpetual upwards march. There's one direction properties are heading over time. And then when we look back at previous financial events, to the older faces in the room, the GFC was a really hard time, right? It was a very, very difficult time for a lot of people. A lot of people lost homes and businesses and had problems. When we look back at it 10, 15 years later, it's almost inconsequential and unnoticeable in the graph. But if I'd cut this graph back to here, it would look really, really horrific, okay? So now, as we go through to the COVID event, yes, it is slightly more volatile than the global financial crisis, but it's a similar principle. When I do this presentation in 15 years from now or 10 years from now, this will be a blip just like this is, and a gradual upwards march, which is increasing property prices because of the fundamentals. I cannot see the population decreasing. I cannot see the government making houses cheaper to build. And because of those two reasons, I believe property will continue to increase in value over time, at a rate faster than inflation. Okay? Do you want me to break this data down a bit more? Is that beneficial to people? Or you can sort of see it? Cool? No, I'm going to do it. Okay. Global financial crisis, 08. We had 1.5 years of decline where prices dropped 8%. We then had a stagnation period of 4 years where nothing happened. I started doing presentations about here. We then had this amazing run. 10 consecutive years where property went up every single quarter. What a time to be alive. It's just amazing. We then hit COVID, okay? COVID, as you know, virus comes into our economy. Government chooses to deal with COVID by closing the economy, sending us home, issuing money, quantitative easing, printing money, and dropping interest rates. What happens when we print money and drop interest rates? The money doesn't sit in our bank account. That money wants to find a home because you guys are smart. You know that capital's decreasing at about 6% a year. So now all this money tries to find a home and assets start rapidly increasing in value. So we have housing, gold, Bitcoin, stocks, shares, all stocks and shares, same thing. So now instead of New Zealand house going up in value 7% a year, like it had for the previous 30 years, it starts increasing at 15% a year. Bang, bang. Government panics. Oh my God, there's too much inflation. What do? Well, let's just drive interest rates through the roof and just choke the hell out of people with debt. So now we have this really rapid correction. House prices drop 15% really quickly, and then we have this nothing period of time. And that brings us to where we are today. So I'm in the school of thought of most economists in New Zealand, which is the lessons that needed to be learnt have been learnt, and we can look at the property market and it should act similar to how it did in the past without this turbulence. So we look at the property market and we go, will properties perform less than inflation? Call it 3%. Don't think so. Will it perform like it did in the peak of the market, 15%? Absolutely not. We're not going to drop interest rates that cheap, and we're not going to print that much money. Will it perform the way it has for the last 32 years, 6.8%? Maybe. Should we pick a number under that because the asset's already more expensive and set that as a benchmark? And so most economists would say, we think property will move at 5 to 6%, which is more than inflation, but less than some of the violent peaks we've seen because of the fundamental imbalance between supply and demand. So what's my summary of the New Zealand property market? Our population will continue to grow. We have a fundamental imbalance between population growth and housing supply. When we build houses, it's more expensive than consumer inflation. It's more expensive than it was the year before. We have rents increasing, we have interest rates decreasing, so we can look at housing and say that will increase in value over time. Which brings us to Williams Corporation funds. Now, why do we have funds? Before we go to that slide. Why do we have funds? Williams Corporation sells more houses than we have money to build. So we go to wholesale investors, we go to people, and we say, we can't keep up with the $10, $12, $14 million every single month of property we sell. Can we use your money to build these houses and we'll pay you 10%? Pretty simple, right? So what's our track record? We came up with this 6 years ago. Since that day, we've raised $290 million. We've returned $197 million. We've paid $56 million in dividends. Today we have $93 million under management, and we have lost $0 for our investors. Now, to the FMA, the past doesn't guarantee the future. etc., etc., etc. But we've got a pretty good track record. So we have 4 funds. The largest is Williams Corporation Capital. We then have Williams Corporation First Mortgage Investments, we have Williams Corporation Capital Partners, and we have our completed home partnership. Starting with Williams Corporation Capital. Now, I can't go through the fund line by line with all of the risks and merits of the offering, but I'm just going to give you an elevator pitch of each instrument. So you're investing in Class A redeemable preference shares. They're $1 a share. So you buy them for $1. At the end of the investment, we pay you $1 for the share. It's got a 10% gross pre-tax return. We distribute quarterly, and we have a 70% internal LVR ratio on our work in progress. Just got to tell you a bit more about this. Myself and Blair, we put the first 5.3 million into this fund. We cannot withdraw that capital. In the event of a loss, that money gets burnt first. We also have a personal guarantee and a company guarantee over Williams Corporation. And this fund has been open for 6 years. We've never missed a dividend, never missed a distribution. And this takes first and second mortgage over our entire work in progress. Williams Corporation Capital LP. This exists to invest in Williams Corporation Capital. Now, when you invest in Williams Corporation Capital, you are listed on the company's office. So you can actually see your share, your investment, everything there. Now, for some of our investors, they weren't comfortable with that. So essentially, we have a limited partnership that you buy shares in. It's exactly the same. And then that purchases the shares for you in Williams Corporation Capital. So it's exactly the same investment. It just has the anonymity of not being on the company's office. Okay? Now we have some people that say, well, that's all well and good and only investing with a first mortgage. Do I have the fund for you? So this only does 2 developments a year, sometimes 3. First mortgage investment, 10% return, 70% LVR, but you've just got a smaller pool of securities. So Williams Corporation Capital is secured over everything. First mortgage might only have 2 projects at any given time that it has security over. Completed Homes Fund. This I do not think will be open very long. This is just a certain timing in the market. So this is exactly the same as the first mortgage fund you saw before, but it's only completed houses, 70% LVR, 10% return. Great security profile on this fund, but I do believe based on our current sales, we're going to run out of completed homes in about 10 or 11 months, and then this fund will be closed and your money will be returned to you. Okay? So if you're looking at something that you want it's easy to understand and you want to do it, this is a great instrument, but just know that the money's going to come back to you mid next year, give or take. Preferably way sooner when we sell all the houses. Now, as an investor, you get an update from me personally every month. I sit down and I handwrite these, so make sure you read them because I take a lot of care. And it always hurts my feelings when I call our investors and ask them about the update and they never read it. They're like, Matthew, I trust you. And I'm like, well, I put a lot of time into this. But one of the cool things about these funds, we transparently show every single update. So you can open the Williams Corporation Capital Drive. You can see every single update since I started the fund 6 years ago, and you can read them. Now, I wouldn't recommend reading every single update. Maybe skip forwards in time 6-month gaps, right? And you'll see a track record of us making a claim, meeting it. Making a claim, meeting it. We always do what we say we're going to do. So there's essentially a beautiful cover sheet. We cover our sales, settlements, rolling 12-month data, anything that I believe is important for you, the investor. I might cover land that we've bought. I might cover some risk that I see. I might cover a win. I might cover a loss. I'll cover what I believe is relevant for you, the investor. We then have some data. of deliveries and fund size and where the houses are. And we also, don't have it on here, we have an allocation table. So each fund will have a list of securities, it'll have the loan amount, it'll have the security you have, how many units, how many of them are sold. So you can actually go through line by line and you can say, I have this security on that project, this security on that project, this security on that project. All very transparent, very easy. So this is the structure for Williams Corporation Capital. Pretty much the fund is a company. You're buying shares in the company. The company will then obtain your relative security. So it's going to be getting personal guarantees, company guarantees, trust guarantees, mortgages, etc. We then have a list of things we can do within that company and what securities need to be obtained for what capital to flow. We do have a minimum investment, which is $100,000, and we have a minimum term, which is 12 months. But you get unlimited withdrawal for settlement of a Williams Corporation house. So if you're a customer that's bought and you have some balanced funds and you comply with the wholesale criteria, you can put that money in there. Or let's say you're an investor and something happened and you wanted to convert your capital to houses, you're allowed unlimited redemption at any time to convert your money into the physical securities that it's securitized over. Like I said, myself and Blair put in the first $5.3 million. We can't withdraw it until you're paid back. But this is consequential but not consequential because you have PGs, trust guarantees, company guarantees. So that's more just a token amount. LVR ratio of 70%, and the key risks are it's a fund that's securitized over houses. Who can invest? All of our funds are open to qualifying wholesale investors. Now, as a rule of thumb, a qualifying wholesale investor is someone with $5 million net worth or $750,000 of cash to invest or in the business of investment. We do have a few other categories that we can accept, but we won't discuss them here. There is an eligible investor category where if your accountant, lawyer, or financial advisor can assess that you can assess the risks and merits of the investment, you can invest. But we really want to be dealing with wholesale investors. That's our target market. The average investment size in the fund is $500,000. So summary, we've been doing this for 6 years. This instrument has been what's kept Williams Corporation safe. It's what's kept us strong. It's allowed us to be incredibly well capitalized through this financial event and allowed us to perpetually build through our houses, buy new developments, and trade in some relatively volatile times. And that's because we're not beholden to one or two institutions. We've got 220 different investors, all with $500,000 in our fund. And it's that diversity that makes us strong. Cool. So, who wants to ask the first question? No questions? Was it that comprehensive? Hello.
I noticed in your figures you don't have anything about what percentage of the population are going to be retired in a few years.
Yeah, good question.
Percentage is 1 in 4. So don't we need more freestanding single-level houses with a garage to suit this population?
Look, it's a very good question. So as far as our kind of product, will we do freestanding traditional housing as a percentage of our book? Yes. Okay, so as we exit this current book and buy new houses, will that be a priority? Absolutely. Will it be our sole business? Not quite. So the way we're addressing that is we're doing more apartments with lifts, and we're not targeting your business as our core person, right? We're targeting the person with less wealth than that can't go into the freestanding home with the garage, but needs the 1 or 2 bedroom apartment and keeps that extra $200,000, $300,000, $400,000 for consumption in their retirement. So will we do that work? Yes. Is it an important part of the market? Yes. But are there also competent operators doing that? Yes. So when you look at our development at 20 Wilma, we have a lift in it, and so that's opening up to that baby boomer retiring, but we're just seeing the market in a slightly different way. Is that good? Yeah. Any other questions?
Yeah, do you think people will be able to afford a house in 20 years, the way they're going up? You're not Michelle. It just seems to me pretty crazy. The cost of a house in New Zealand is madness.
Yeah, and that's a fair.
It stops other industry like the arts and restaurants and people going out buying cars. Well, I still see buy cars, but it slows down the financial situation, does it, or does it not?
No, so great question. So gentleman's question is, can the houses keep going? Should this money be put to other uses in the economy? So can it keep going? You only need to look to Sydney across the ditch and you can see it can triple from where it is now and the market seems to still function. So we have a physical case study 2 hour flight away showing us that houses can triple and it appears to still function. Is that the best use of capital? Probably not. But I'm not the government. And maybe one day we'll go public, we'll get our big pot of gold, and then we'll go teach them how to make houses cheaper. But until that day, we have to play the cards we're given. We're in a very restricted economy. Every year it's harder, every year it's more expensive. And so based on the information that I see now, I think it's going to keep going how we've seen it. And then if we get new information, we'll adapt and adjust accordingly. But on a spiritual level, look, to be honest, housing's only about 6 times wage, the median wage at the moment. There's a lot of economies where it's 25 times. So there's definitely scope. Hey, Tony.
Okay, the opportunity to build more houses within the city centre is becoming less because there's less land. When you've done Manchester, which is 6-storey, are we going to see more of that happening?
Manchester, so will we build more big projects? Manchester's amazing. I love it so much, it brings me so much joy to drive past. Will that be our core business? No, because too scary and takes too long, right? So will we always have one legacy or cool so Manchester will be 4 years, 2 years of consenting, 2 years of construction. It's 100 houses, so it's the equivalent of 25 houses a year. And as of today, it's 50% of our homes under construction and 20% of our entire book. Will we perpetually have something like a Manchester Square? Yes, because it's cool, right? But will that be our core business? Absolutely not. Our core business is going to be this 2 to 3 story, timber-based construction, attractive areas, competitive price points, 6-month consenting, 6 months delivery, in, out, bank money, next one. That's what keeps the business safe and strong, is that perpetual movement of capital. But it's very special, and it's something that we have done that will forever be here for our city, and it's something that I feel very proud of, but it's not something that's going to be any more than 20% of our book at any given time. Cool, it looks like, oh, yes.
Construction costs will go down because now they're going to change the rules so you can import construction material?
When the government says we're here to make it cheaper and easier, we're here to help, that's what you hear, but then what they're actually saying is we're going to make it difficult and more expensive. No, without being facetious. Look, I've just been told so many times by bureaucrats that they're here to help, look at all the clever things I'm going to do, and it's never actually eventuated. Hopefully this time is different. I really do. I actually don't want to be cynical. And if we do get housing cheaper, we'll see that and adjust and make a new strategy. But I haven't physically seen it, so I'm not going to act like it's happened until we physically see it. Cool? Right, looks like everyone wants drinks because you already started doing it. So thank you very much. I hope I put on a good show for you. I appreciate you here. We've got food, drinks, and heaps of our team. Cool, thanks.